Hi everyone, Adrian Player here, mortgage broker. We mainly focus on property investors. They're 95% of our clients. So in this video, we're going to be going through this post that I saw on a property investment forum. I'm going to read it out to you and we're going to talk about it. And this is one smart investor and an example of how you can make money when you don't follow the crowds. There is plenty of ways to do this in multiple markets. So let's read out the post. After my son James, Airbnb guru, suggested we buy in southeast Queensland, we purchased 5 townhouses in 5 weeks in February and March of 2022 for a total cost of 1.491 million, placed 10% deposits and had a mortgage insurance. All had yields between 6.5% to 7%. The 5 suburbs were Slacks Creek, Gales, Browns Plains, and Eagleby. Okay, and you can see the prices that they paid for it, and you can see that the valuations as of now. Fast forward less than 2 years since settlement, and we have a rental return of $112,060, which is expected to rise to $118,000 by later this year. And a value based on recent sales in the same complex, similar condition, of circa 2.13 million, which is a 40% increase in value. The downside is the strata and the council fees. The upside is the yield from day one. We de-risked by spreading our risk over several properties, allowing us to sell quickly if we got into strife without having to sell all properties. Also, downside was extra conveyancing fees and mortgage insurance. ANZ offered rates same as someone with a 20% deposit, which did help the client. Another downside is no chance of development or works on the property or uplift strategy on the property. When purchasing each property, we worked with several property managers of townhouse complexes and got to know them well before locating the right property to buy. All inspections were FaceTimed as we lived in Sydney, not one physical inspection. I wonder if we had purchased one property for 1.49 million, if the price would have been increased by as much. I assume the yield would have been lower, but that would have been offset by no strata fees, council rates, but more insurance cost and repair costs. Strata covers the majority of repairs externally and covers the building insurance, so we de-risk repairs and costs. On a tax point of view, if we sell, we can structure each sale over several years to ensure our capital gains is limited to a lower marginal tax rate. Business owners, so we can simply not take a wage in a year to keep the tax within a lower threshold and pay 25% company tax. Okay, so this is a strategy where someone has bought townhouses, villas and units, and they actually bought in the same similar area to what I did in Woodridge, and my purchase price was within 4 months of these guys, and I got my 2 units for 161k and 162.5, and the prices that these people were paying, I've got a very clear example of emails that I got from my buyer's agent where you would be getting at least in the high 2-betters when I was looking at it in Woodridge were going for about 165 to about 185 in the range. And right now there's comparables which are over 300 grand for townhouses, 2-betters at the moment in the last 3 months in the suburbs. So it's very easy in this example for this person to have made not 40%, but closer to 80 to 85% on that money, especially if they had the right buyer's agent with the right deals, and they were searching around for the right ones. This person may not have had access to that, but they did extremely well anyway. Now, when we talk about buying one property at 1.5 million, you've got to be talking about the difference in the rates. So the difference in the rates is somewhere around 4.2%. So when they bought to what it is now, and the yields on those numbers, even with the surging rents in Sydney, would have been minimum 20, 30 or 40 grand negative. Okay, so I would assume that on a actual low end, this person was probably 30, if not more, negative 30K a year. If they went and bought one property at 1.45 million and it was just a standard house in Sydney. Okay, because I've got examples of my parents' property. It's worth about 2.3 mil in the southern suburbs of Sydney, and they're only getting in excess of, give or take, 1,000 to 1,100 a week. Okay, so you can kind of see where that's going on those kind of price ranges. So I think I'm being very giving in that. It's probably closer to 40 grand negative or more, after you account for rates, fees, and everything else. And obviously you get a negative gearing portion back, but that's only if you have the ability to hold between tax returns. If you go bankrupt halfway through the year, then you are shit out of luck pretty much. So and a lot of people, if they buy one asset that far negatively geared, it impacts their emotions. Their money is going out of their account every week. They're barely getting to tax time already with all the other inflation costs. So would you really have held it for that long, or would you have sold it because it went so far negative and all the other inflation costs have gone up, so your disposable income is squeezed? Would you really be holding it over a 3 or 5 year process without having 500 grand or $1 million cash buffer sitting in your account? Okay, so and the other ingenious strategy that this client has is, if they wanted to start selling off, they sell one this year, one next year, one the year after, and then they're running a company, so they could retain all their earnings in the company, not pay a dividend, not pay salary, pay 25% tax, and have the capital gains hit them and pay less tax. So I think overall this is a great strategy, and people can make a lot of money. And the good thing about this strategy is house prices move first. So you are not guessing when the value hits these units, townhouses and villas. In Brisbane, it was clear. Okay, it was the biggest gap between house prices and units in 12 years when I bought, and that gap is always going to close. You don't know exactly when, but if the house prices have gone up that much, it's not a mining town, so it's not a spike and going down. The units will always catch up, especially if you're buying in the small boutique units, or you've got a water view, or you're close to infrastructure, you're not in high density. Okay, and same with the townhouses and the villas. People have to live somewhere, even in these low socio-economic areas. So I say hats off to this investor. They've done extremely well, and this is just another strategy and approach that not many people take, and because of that, not many people take it. So you can already see markets that have boomed where the house prices have gone up through the roof, and then go in and buy all the high yield units, townhouses and villas. Closer you can get to CBDs, the better, and you can make these kind of returns. And if you have a buyer's agent that's able to get not only what you see online, but better prices and access to off-market stuff, because these are the kind of ones that everyone's throwing their property online, right? Not in the apartment, the townhouse, villa space. Okay, there's a lot more chance of off markets, and they don't think that they have the pull as all of the others. And then you buy it, you hold it after the house prices go up, and then the market closes the gap, and you make the return. Okay, so this is a strategy that you could implement. This is a strategy that you can make money on. Obviously, there are ways that you can structure these as well through trusts or doing larger deposits, so you're getting 6, 7, 8, 9% 9% rental returns, so you can borrow a lot more. And also, if you're going after the 7, 8 and 9% stuff and you're doing a slightly larger deposit, you can put these inside a trust and pretty much recycle your borrowing power. So just keep on buying. So you're not limited to that, 3, 5 or 7 or even 9. You can just keep on going as long as the trust is profitable and the accountant will keep on signing off. you can do that. But a lot of people don't tend to like doing that because the cost of the trust setup and the cost of the annual compliance per year, and each property a lot of the time in these kind of situations is under 350 grand. So if you're doing that on a per trust basis, it does increase the fees a little bit. So that's just something to balance out. And also when you build a large portfolio with kind of stock, you are not paying as much land tax because there's less land component. You're not paying home insurance because you're getting the strata to cover that. Okay, so you are getting access to things there. All right, so I hope this is giving you a lot of value. Hit that like, hit that subscribe button, leave me a comment. And if you want an investment focused mortgage broker, here I am. I'm in the space. I've built a large investment portfolio myself. We've got hundreds of clients doing the same. And we are constantly hearing clients saying that their borrowing power is capped or they're not structured right. This is our bread and butter. We do this every day of the week. All right, hope you have a good rest of your day. Take care. Bye.